Good morning, everyone. Thank you for attending the Place Your Trades Network Spaces to discuss energy and metals. This Spaces is brought to you by Tradeovate, which has a custom web app dedicated to trading CME Group's new daily option contracts, including indices, energy, metals, and now Bitcoin. You can also trade these on the DOM on Tradeovate's main platform as well. It's a great way to get exposure to the futures market with defined risk. You can use the link in my Twitter stream to go get the Tradeovate app for free. Also write a weekly blog on markets that you can find at placeyourtrades.com. It's free to access. Just sign up, click on Tracy's blog. Now to introduce our guests. We have Leonid Mironov. Sorry, Leonid. Leonid's currently head of natural resources at PACAT Capital Management in Hong Kong. He's a strategist, portfolio manager, analyst, and PE advisor with over 15 years experience in emerging market natural resources across blue chip investment banks, specialist investment banks, and PE firms. He possesses a detailed knowledge of metals, oil and gas, and soft commodities in Asia, Russia, and FSU. Leonid's particular focus is on the impact of energy transition and ESG in the resources sector and economies as a whole. Both the evolving impact on the resource space directly with Scope 1 to 3 emission curves, shifting value within the resource space from energy to metals, as well as the entire value chain. Impact analysis from cradle to grave. Second, we have Jeremy McCrea. He's a CFA. He is Managing Director of Energy Research at Raymond James. He joined Raymond James in 2015 as an energy analyst with more than 20 years experience exclusively covering the Canadian oil sector. He advises many top funds in Canada and oversees $100 billion worth of energy assets. His views also are frequently sought by media outlets, including Globe and Mail, National Post, Bloomberg, and BNN. Raymond James Financial is a multinational independent investment bank and financial services company, providing financial services to individuals, corporations, and institutions. So welcome to both our guests. Thank you so much for taking time out of your day. We'll get right to the questions. So first, we'll start with Jeremy for the first round. I guess first and foremost, we should talk about these Alberta wildfires, very tragic, and kind of the impact on the oil and gas sector. When do we already know that some of this has come offline. You can go into detail more of that and kind of talk about, is it mostly gas or mostly oil that's shut in? And when do you expect this to come back online?
Yeah, thanks, Tracy, for having me here on the show. When you look at these Alberta wildfires, it's pretty amazing how quickly this all sprung up here in the month of May. Typically in Alberta, it's our rainy season, so I think this is surprising a lot of guys and how quickly this is percolated throughout the province here, and not just in one area, but throughout. So far, we've added up about a few 100,000, BOE that has been shut in, with many more operators indicating that they're trying to assess, just how much of their production is shut in here as well too. And there's some preliminary reports that came out on Monday. Some of the quarterly reports even today said, it was actually even more than that. It was closer to, it was kind of double that. And one of the biggest issues, though, that is actually quickly being resolved is one of the main trunk lines that supplies where a lot of these companies feed into, basically the Pembina system, just through cautionary. They shut in one of the main trunk lines here, and so that's why you saw as massive the shut-ins as much as we did here. So hearing preliminary reports from our guys in the field, that is starting to come back up online here now that some of these forest fires have dissipated or the risk has really subsided. And a lot of these operators are just going through their upstart procedures. And typically that can take 2 to 7 days, depending on where you are, how close your field staff are, and how many checks and balances that you're doing here. In this type of ESG type of world now here, it may take a little bit longer than what we've probably would have normally seen even 5 years ago, just as guys are very cautious about making sure, was there any, damage from any of these fires, and really going through a bunch of these procedures here. So I suspect once all said and done here in the next week, with a lot of the forest fires really subsiding here with some rain finally, we'll get a better clarity and idea. The one thing I would say though is this is not unusual for Alberta. A lot of times we see forest fires rip through the province, let alone, this is quite early, but in the summertime where, there is these shutdown procedures. This is just unusual, just given one of the main trunk lines that shut down, which was, quite a bit larger than I think anybody was expecting. But, for an asset that effectively is, your production is deferred by a couple of weeks, these are assets that can improve for 20, 30 years here. So when you see the share price reaction for some of these stocks, it's a little unusual and overdone, it seems.
And do you know, if at all, what impact this has, or how large of an impact it's had on exports to the U.S.?
They're still working through that. There is some pipeline, not pipeline issues, but just the way the inventory has kind of been built up on the lease sites. Ultimately, that's going to get transported here, and there's been some minor hiccups, but nothing that you would probably notice if production gets back up and running here in the next few days.
Excellent, thank you. So okay, so let's move on to kind of more of the institutional side now that we got over the wildfires. So how are you, since this is what you do, how are institutional investors impacting decision making in oil and gas companies? And if so, how is this impacting supply, if any? And what are some of the biases right now?
So one of the things we talk about with our institutional clients is where are their biases in the market here. And when you speak to some of the largest money managers here in the country, and where their perceptions are, where their biases, what are companies thinking, and how are they listening to these investors, you can get a better idea on the supply side of the equation. And I think it's probably a good proxy for non OPEC type of countries here as well too. Part of the hardest thing in forecasting oil prices is the demand equation. I don't think anybody really knows where the price of oil is going to go. I don't even think the king of Saudi Arabia knows, has a strong indication of, where oil prices are going to go here, a year from now. But where they do control is the supply side of things. And when we look at North America, we kind of look at the biases in terms of what do shareholders want and how is that impacting management team. So one of the things that we always do, semi-annually is what we call our Raymond James energy survey, that, we pretty much get a response from the top 50 oil and gas companies here in Canada. And the one thing that's pervasive here is when you ask, what is the reason for holding back growth? The biggest answer is reallocation of cash flow to dividends and buybacks. That is what our investors are asking for, and effectively, that's what they're following through with. And then when they see their share price respond, over the last couple of years, they basically say we're not in a rush to add a bunch of more production here. The other thing, especially with the volatility in oil prices, you see. And when we talk to these management teams saying, you're making some good money here, your profitability is some of the best it's ever been, why aren't you expanding? And they basically say the volatility that we see on a daily basis, really has us concerned that we don't want to fall in that same trap where we decide to greenlight some more wells to come on, only to bring those wells on with this, with under a low price. And so this type of volatility really keeps a lot of guys in there, and they're spending constraint here, just saying, we're just going to continue to pay down debt here as oil prices remain volatile. So ultimately, your supply over the next year kind of thing really is not going to be as high as you want. And even the EIA just came out with their recent short-term energy report, and you can see it on our tweet yesterday. The EIA revised down U.S. oil production by a couple of percent, and you can just kind of see where their bias and their models are heading here too.
Yeah, absolutely. I think EIA has been overly ambitious in their in their forecasts. So it was good kind of to see that come back down to reality. And really, we're seeing in the U.S., the same things that oil and gas companies are saying up there. We're seeing that in the U.S. as well. So that's not that surprising.
I would like to.
As far as production.
Yeah, one of the other interesting things is always the Dallas Fed survey as well too, which is a bit of a, similar to our survey, but the Dallas Fed does it for the U.S. operators, and there's a few things that always come out of the Dallas Fed survey. One is they do a level of uncertainty. How uncertain are you? And the uncertainty this last quarter was as high as where we were in peak COVID, like so March 2020. And so when you have that kind of uncertainty, you're not about to expand your CapEx program. The other thing was when they asked, what's been one of the biggest holders holding you on growth? Supply constraints was number one, but number two, though, which is I thought was a little surprising, and maybe not surprising, maybe not kind of thing like that. Maybe that's not the quite word I was looking for, but quality of inventory is diminishing was the number two reason why they're saying, you know what, we're just our quality of inventory is just not there anymore here. And so when that's your number two reason, you're not about to go build a bunch of new facilities to bring on more production in an area. And then the third thing is when the question was, out of your two top plays, what's your break even in your two top plays? And the average price for all operators is now $62 WTI. With the Permian plays up $9 year over year. So when you add in, your dividend commitments, that you're kind of at those levels here more or less today where WTI prices, and it really shows you maybe where there's a floor here in terms of new supply coming on, because you can kind of just see, U.S. operators are saying, you know what, we're going to continue to focus on profitability. We're not going to expand our supply here. And I think, over the last decade, that's been your biggest swing producer that looks like that is, finally abating.
Excellent points. Absolutely. So then the next question before I rotate to Leonid, and then we'll come back to you. What are institutional capital flows looking like into the sector in Canada and the U.S., if you have that?
Yeah, so one of the things that we always do is look at, your 13Fs, your alternative monthly reporting, what you have here in Canada. And basically, we track every fund that has ever owned a Canadian E&P over the last 5 years. What are those funds buying and selling here today? And, it's on research notes, but basically the highlights are you've seen a record amount of capital come into the Canadian energy sector here in the last quarter. We'll get the next update here in the next few days, but it continues to rise more and more. And the more important thing, though, is you're starting to see large AUM funds come back into the Canadian sector. You haven't seen them for the last, 3-4 years, but really just in the last couple of quarters, they've, taken down some of the biggest, large cap names here. We haven't seen them move down into the mid cap sector yet, but that's it's good to see those large AUM funds finally come back into the sector. These are the funds that are run $70 billion plus in assets under management. So when those guys come back into the market, those are the ones who can really move stocks here. Maybe just one more thing on that actually is everyone's kind of looking at the volatility in the oil and gas stocks, and if I look at the type of funds that have been buying over the last few years, a majority of those funds have been high turnover funds. So your hedge funds, they have a high turnover, will turn over 50% of their stocks in a given year. That's been switched now where it's actually more low turnover funds who have been the majority of the buying here over the last couple quarters. So you have, why you're seeing this volatility is as oil prices have come down, these high turnover funds have been quick to exit their positions, and that's sometimes why you're seeing this volatility. But a lot of that stock is ending up in the hands of low turnover funds which will have a much more stable, investor base here going forward here.
Excellent news for all the investors on here. I know everybody likes to hear that one. Thank you. So we're gonna go turn to Leonid for a couple of questions here, and then we'll come back to Jeremy. Leonid, all right, we have to talk Russian flows a bit here. They announced a 500,000 barrel per day cut, but we really have yet to see this translated into lower oil exports. So do you think this will filter in? Do you think they actually did cut? And then are they allowing secondary sources to count barrels as they announced that they no longer be publishing these numbers?
Hi, Tracy. Thank you very much for having me again. And straight to the point. I think they haven't cut. I think, in fact, last time I was on, we talked about how Russian oil supply numbers are probably going to be a very tricky metric to follow because they're likely to add opacity and they'll try and likely hide the true numbers from the West effectively. And this is basically what happened, except instead of being murky, they outright said, we're not going to tell you what we're doing. I think it's very important to separate a couple of levels at which data can be reported. So you can look at the wellhead data, you can look at the volumes in the system data, and you can look at shipment volumes, right? And all of them are somewhat different, and all of them have slightly different dynamics behind them. Right? I think the one that we should all worry about is the shipped amounts, right? Because those are the ones that are impacting the world markets. And I feel like those numbers are not going to go down anytime soon, mostly because the government needs the oil revenues, right? And, for all the talk about long-term collaboration with OPEC, long-term collaboration with the Saudis in particular, and how Russia and China, are best buds now, and this is a long-term partnership. All of this is true, but there is also an immediate need for currency in Russia right now. I remind everybody that this time last year they introduced a mandatory sale of foreign currency revenue. So, like, if you have export revenue, you need to sell at least 80% of it to the central bank. And this has been done precisely because, one, to help the currency stabilize, of course, but two, because they foresee the need for said foreign currency. The worse the operation in Ukraine went, the greater the need for said currency was in order to pay for all the clandestine imports that they're doing of all the things that they need in terms of drones from Iran or chips or whatever chips they can get their hands on, right? These pressures are not abating just yet, so therefore they're trying to raise as much money as they can. I think it's fair to say that originally everyone's concern for volumes has been correct, that the Russians were likely focused on trying to generate revenue through volume control. And as in, they will try and limit the amount that they sell overseas, thereby controlling the prices. And this will work because you have a compliant OPEC, you have Saudis who are willing to play by the same rules, and you have Iran that is also willing to engage. However, I think the U.S. actions and being quite so aggressive on the release of the SPR made it a very costly strategy for Russia. I think maybe in the environment of unlimited money, they would probably have continued with it. But I think sometime at the beginning of 2H last year, they've pivoted and they've decided to go for volume maximization strategy, right? And I think we are still seeing the results of that to this very day, right? I think all those big sell downs in oil that we see regularly, right? I mean, I'm sure sort of fellow market watchers can relate, right? I mean, you wake up and you see at 9:30 at New York Open, right? You just see this massive candle down, right? And I actually don't think it's anything too manipulative. It's rather, these big one-off sale amounts trickling through the system, right? If you think how this oil makes its way through the system, you'll know that it actually makes an awful lot of sense to how, if you happen to be a company who is able to participate in buying cheap Russian crude, it's actually not the worst thing in the world to try and short some amount on the paper market just to minimize exposure, but also not to have that much cash tied up on the whole operation, right? And this, I think, is the mechanism that maybe some people didn't think. I certainly didn't think of it up until sort of very late last year, and I think this has become a lot more prominent, especially now that the Russian attempts to talk the market up all the while selling all the volume that they can, you can only go for so long, right? Because at some point market realizes that and sees the end result. At the same time, the longer you do it, the more upset your quote-unquote partners become. So, like, how long can Saudis tolerate that sort of behavior on the Russian side? I think it's an open question, and this is all a bit, theoretical, of course, but I think the net result is I think there's no shortage of Russian crude, and of course, if you think about the impact that the sanctions, the way that they've been implemented, have had, is that it's given the buyers of Russian crude extra ammunition to depress the prices further, because I'm sure China is only too happy to pay less for Russian crude. So is India, obviously. And given the ammunition to hold the prices down, they're quite happy to pay less. And that in turn drives down the prices across the product spectrum, right? Because the thing about Russian crude is it comes in many varieties, right? You have the very light ones like Sokol or ESPO, but obviously the mediums like Ural. So it's affecting the entire complex, as it were, right? And I think all of this is likely to persist until at least the end of summer, and basically we'll see what happens beyond.
That was a perfect answer. I was going to ask you about the Saudis, but you already answered that. So let's turn to metals here really quickly. And so we have seen EV production increasing in China, right? We have deficits forecast across most EV metals and battery metals, but we really haven't seen much strength yet in those. And so what do you think are the causes of this? Is this all recession fears? Is this, China's just, not producing the numbers as quickly as we thought they were in terms of recovery?
I think, it's specific market to market, right? I mean, if you look at lithium, right, it's down, 73% year to date. And obviously, despite the strength in EV production, despite the increase in the numbers and the sales numbers across the board, just the squeeze in lithium last year was so big that it was quite natural for it to come down. The other thing I would maybe draw people's attention to is the Chinese government's approach to margins in mining, right? And this is not a new thing. This has been going on for as long as I've been watching the space. So, for example, if you consider the phosphate miners in China, for example, right? I mean, you look at the market price of phosphate in China, it's been at 3,500 RMB for quite some time. But those aren't the prices that your miners get, because you look at Qihai Salt Lake as your sort of reference point, right? And if you back out the average sort of price, it's probably around 2,000 RMB a ton, right? Why? Well, because there is strong incentive from the government to make sure that you have cheap fertilizer for the farmers. It is ironic, therefore, that you see lithium that is actually used not by small holding farmers or anything like that, but by big industrials like CATL and your BYDs of the world. But lithium is, in my mind, fallen in roughly the same category, where the government has decided that there is no profit to be made, or only normal profit to be made in lithium mining, and most of the opportunities to be passed on to the higher complexity enterprises, so your battery makers and your EV makers, right? And everything that is onshore China in that regard will follow that path, right? I mean, that metal miners who have facilities in China will not be able to take advantage of price squeezes. Now, The control over overseas production, of course, is more difficult, and you have a very different set of clients who are purchasing your output, right? So Chinese enterprises with production overseas are not subject to those constraints, or at least less so, and which is where you see more discretion. But even then, you look at things like nickel, right? We've had obviously all the unpleasantness with Tsingshan and them almost going bust, and LME kind of reversing all those trades last year. But even outside of that, right? I mean, what drives the nickel market, right? And we've been talking about EVs for a couple of years, and it's that demand is materializing slowly, but still, right? I mean, the backbone of nickel demand is stainless steel production. And that's going to remain the case probably until 2027, 28 at the very earliest. And if that's the case, right, it's the market for steel that's more important. And quite frankly, the rebound in Chinese demand just didn't materialize to the same degree as maybe some of the optimists have expected. Now, that doesn't mean that it's not coming, right? It's quite likely that second half is actually going to be quite good for them. But as things stand right now, the demand has proven to be somewhat disappointing despite the strength in EVs, right? And I think between the government policy and between the slightly weaker rebound in properties, I think it explains most of the specialist metals dynamic.
Thank you. Excellent. And then let's move to, I'm moving you everywhere today, but I wanted to talk about nat gas and LNG because I know everybody's asking, you know, is this ever going to get off the ground? So we have hotter than expected temperatures across Asia right now due to El Nino. You know, it's only going to get worse in the summer. We're already seeing scorching temperatures right now. This obviously will affect electricity demand. You know, do you see this as bullish, you know, nat gas, LNG? And if so, do you expect this, because we are not yet seeing this reflected in, say, you know, JKM or TTF prices? And is that due to, you know, is that due to Asian storage being full because China's already predicting shortages?
Well, I think, again, let's revisit last year, right? Last year, we've had a year of competition for volumes, right? I mean, Europeans came, bought all the LNG, left Asia with very little, right? And in fact, China rerouted a bunch of their cargoes into Europe, right? This year, Europe is not buying quite as actively, although they're refilling storage now, but relative to what they were doing last year, it's not quite the same, right? And again, I think it's important to remember the motivation for Chinese purchasers, because whilst they're concerned about volumes, because they have a diversified energy policy, you know, they don't need to focus on LNG alone, right? They can actually figure out what makes sense, what kind of reserves they want to build up and when. Therefore, they will not be the ones pushing the prices up. Right now, I think the parts of Asia that really need energy are not in a position to bid up LNG, right? You look at Pakistan, again, like I think I mentioned it last on our last call. Pakistan would love to import more LNG, they just can't afford to, right? And they have no money and nobody's interested in rupees, right? In fact, it's interesting. It's coming out now that they're offering to pay for Russian supplies of oil and potentially LNG in yuan because they have some. These are all interesting developments, but the one thing they're pointing out is that they're unable to get the volumes that they need from conventional sources and conventional markets. And by conventional, I mean open and unsanctioned, right? So I think it's not surprising that the trade is not picked up to the same degree, because there is all this storage, all this gas still in storage that's overflown from last year. And I think in terms of volumes, Chinese guys will come in when it makes sense for them. And I don't really have a number for you there at what sort of JKM rate they will. But they're certainly very price sensitive, and I think they will wait. And maybe knowing that them coming in might push the prices up, they might wait longer than people would otherwise expect.
Thank you. All right, we'll go back to Jeremy while we're on LNG. Can you kind of give us your outlook on the global LNG picture? I mean, Europe's pretty full right now. And then kind of talk about, you know, Canadian potential going forward. As far as exports are concerned out there, other than the United States. and what it's looking like for the U.S.
Yeah, and I'll maybe preface this in the views of investors here and how they're positioned in stocks and their views more so. Uh, Effectively, when they look at the global LNG price here, there's two camps. One is, it seems like we've somewhat got complacent here in terms of the Russian supply of gas into Europe. And yes, storage seems healthy and it shouldn't be an issue, but there's a lot of saying, are we sure we're out of this mess here? Um, and I think one of the biggest things that is coming, and as guys look to reposition back into some of these gas weighted names here, is if you look at the winter here in North America, which led to healthy storage levels, is it was only a one standard deviation off your average weather here in terms of how warm it was. So expect that to happen once every 3 years, this type of winter. But the fact that we really haven't built new gas storage really at all, over the last, 20 years here in the US and in Canada. This is why you're seeing the volatility of gas prices move as much as you do here sometimes, just when, really not that big of a warmer winter can move the price that much. So on the same token, you get a cold winter, um, it could potentially move the prices, quite a bit higher here. And so there's this bit of a lull in the market as we go through the shoulder season, but there's some investors saying, it feels like, the pessimism on gas has gone too high, and we need to maybe start repositioning into some of these gas-weighted names heading into the summer and then even potentially for the winter. As it pertains to Canada and our LNG projects here, one of the main facility, this is LNG Canada, that's well on its way. We should start to see, exports, starting here in mid 2025. But the second phases and some of these other projects like Cedar, and Rockies, one of the biggest issues that we've had here in Canada is just the proper consultation with the Indigenous groups and our ESG type of framework here that we have with regulations. And effectively, one of the issues why we haven't seen phase two get announced here quite yet is how to get renewable energy to basically supply the cooling here that we need for the gas, and where are we going to get those transmission lines to come all the way down here to the west coast. And so that's one of the biggest holdbacks here right now. So effectively this project can go ahead if we can find the renewable energy, and we just haven't been able to sort that out here with with one of the largest utilities in BC. So that's where things kind of stand here. But for the most part, though, a lot of the issues that we had in the past have somewhat resolved with, kind of the Indigenous groups who seem more supportive now going forward. Not everybody, but, a majority are still on board. And it does seem like this is one of those projects that will finally get off the board. But there is a lot of LNG potentially coming here for Canada over the next several years. So really where it would take about potentially 50% of our supply here that we currently produce here today.
And then, the Fed's talking about how, with the banking crisis and everything, we're expecting, credit contraction. I'm not sure if Canada is expecting the same kind of credit contraction, but, do you think, and how would this affect funding for natural resources projects?
In Canada, we're a bit of a unique market here where most of the lending is done by our big five banks, which even in relative to US, and not that I do much in the banking sector here, but relative our big five banks, I think would be all in the top 20 US banks, if not some of them even in the top five here. Like it's a very consolidated banking sector and lending group that we have here in Canada, and that's effectively where you don't see the credit spreads and that nervousness as much as what we're seeing here in the U.S. That said, though, when you talk to different lenders here and different operators who use the banks, like we always do this one research thing that we generally post on Twitter here as well too, and it's looking at the banks lending to the oil and gas sector. And since the generally peak of COVID here, the lending to oil and gas has declined by 50%. So that's partially what, just E&P saying, we don't need to take on this much debt. But it's also just a reflection of what we're hearing from different lenders here saying, we really are picking and choosing the companies that we want to lend to. And it's really come more and more down to a narrow list here. So, these companies are just having way less debt, which really isn't impacting nearly the credit spreads here that we've typically seen before.
And are you seeing this? I'm not sure if you know, but are you seeing this the same in U.S. banks as far as funding going down for projects or funding just drying up?
You know what? I haven't looked at the U.S. banks in terms of their lending here, but if it's anything as a Canada's a good proxy for what we see in the U.S., I wouldn't be surprised if that's the case.
Thanks. All right, let's move. Let's talk about kind of Q1. Most earnings have already are out yet, right? So we saw great earnings. Do you think this will carry over to Q2 now that we've had a little bit of softer oil prices? Then kind of talk about what do you see in the way of demand for summer in Canada, the US, perhaps global. And then I know this is a multi-part question. I wanted to kind of focus on refiners also because they posted really strong earnings. And most of them all were saying they don't see a dip in demand where, we've seen oil prices come off because everybody's talking about how there's no demand. But like Valero, for example, said gasoline sales were up 16% year over year. Diesel volumes were up 25% year over year. Demand strong in our system. And they just don't see any diesel weakness. Well, as far as diesel weakness, we're just not seeing it. Distillate fundamentals look pretty good. So, and that's pretty much been across all U.S. refiners, kind of reiterate that. So, if you could address all of that. If you forgot what I asked, I started with Q1 earnings, and will this carry to Q2?
I'll start with Q1 here. So for the most part, and especially nowadays here with the oil and gas sector, there's a lot of real-time information that we get on individual wells and production. And, by the time the quarter comes around, we've already have the production data here adjusted for any kind of outages, and same with the commodity price. We have a good idea what the commodity price is here as well too. So rarely are there any misses with quarterly results for E&Ps anymore. Like you don't really get the big misses and the volatility with that. More importantly is what do we see with guidance and how that gets adjusted up or down or any kind of new shareholder return policies that are more the drivers here now. And so far for Q1, we haven't seen any real big moves one way or the other here. The one thing I would generally say is the commodity price seems to be in a bit more range bound, especially with OPEC coming out a few weeks ago, just saying, you know what, we're going to do our cut, and this is the price that we want to maintain here. And so there's a bit of optimism with a lot of these companies that, we don't need to, cut our capex anymore. We can probably kind of keep at the same level here too. And we're not quite sure how high the oil prices may go, but we're not going to spend anything more to have on the expectations that prices are going to go higher. So that's why you saw for the most part no change to guidance. And I think heading into Q2, you'll probably see just kind of a steady budget here of just and a lot of the free cash flow will just continue to be paid down in debt. I just want to go back to that survey that we did here before, and the one thing, one of the questions that we asked was, how many companies are going to either sell or merge here over the next 6 months? And so this was back at the end of or beginning of April. And one of the and the questions, 2, 3, 4 or more, and 83% of CEOs said there's going to be at least 2 or more companies, public companies that are going to sell or merge here in Canada over the next 6 months. Like it clearly tells you, there's more going on behind the scenes than I think any of us really realize here. And that's why you're not seeing CapEx budgets go up, kind of holding steady, debt being paid down, and just building a cash reserve here, or like a war chest to basically go, pick up some of these some of these companies. The other thing I'll emphasize here is you've seen a few big companies now in Canada sign LNG agreements, just having pipelines go down to the Gulf and start to get contracts here with some of the Gulf LNG operators. And you're looking to see more of these operators here try and get those agreements. The problem is, to get an agreement, you need to be investment grade, and to be investment grade now, you generally need to be a couple 100,000 BOE. And so there's a real realization that some of these operators who are 50, 70, 100,000 BOE probably need to partner up with somebody. And just one partner would get you that investment grade, which likely gives you a much better pricing dynamic here, going forward. So, I really do think 2023 is going to be, see finally a lot more mergers of companies here, and ultimately those bigger companies are going to go attract, new investors here. And we talk about large AUM coming into the sector, large AUM funds. They're buying the big guys. They haven't come down to the mid cap, but this is where you start to see, a couple smaller companies merge. That's what's going to attract the attention of some of these larger AUM funds.
Yeah, that absolutely makes sense. So how are you seeing demand, at least for Canada and the US going into summer? You can touch on global if you want. Again, we've seen prices kind of calm down. We've seen those refining margins come off. So everybody's, got this recession fear. We're all going to, stop using oil and gas tomorrow. So do you see strong demand, at least in the US and Canada going into summer? And what does that mean for refiners?
Yeah, you know what? That's the $1 million question that I think everybody has here. And there's a lot of money and trade that goes on. And my opinion is this recession fear has been ongoing for a couple of years here, that we're heading into recession. We're heading into recession. When's this recession going to happen here? And there's a lot of data that supports that. We're sure we're heading into recession, but then there's a lot of data that says we're not. And I think this is the you kind of just could look at the the forwards curve here and see what it's indicating. But so often, that forward curve, can really does miss the mark here in terms of what we're actually going to see. And so it's hard to really forecast. What is the demand going to be for driving season and that. I think it's just almost an impossible task for anybody to have accurately. It's more important to understand how are other people positioned and viewing it, and whether there's a lopsided bias one way or the other here. The thing that I think is being maybe missed this time around is how many people still work from home here. Pretty much everyone in the financial industry still works, 2 to 5 days at home. And so even if you were to see a global slowdown and less people driving to work, these people aren't already coming to work anyway. And so this is where, your old models may not accurately be predicting what could be coming if we do see this recession. So it's these type of things that, their conversations with investors, and, have this been thought of, how are old models, not properly calibrated for today's market here. So these are kind of the things that, are you're trying to consider if that's being priced in or not.
Yeah, that's a huge, huge point. Thank you for pointing that out, because I think that people forget that it's not everything's the same. And usually when we have seen recessions, I just want to throw that in there, you see, even if we see oil and gas demand come down, it's usually the first to recover out of anything, right? We saw this in 2008, 9. And, we saw this in, 99. We've seen it almost every session, that it is the industry that is first to recover, because people have to go find jobs and send their kids to school and still live their lives. So I just wanted to point that out. And so last question here, before we move to Leonid. Do you think, so again, obviously, we keep talking about potential recession. We've got rate hikes that have affected oil and gas demand sentiment, or at least, as far as prices are concerned. We have softer data in China. So we know that these are, the risks that we're facing right now. Do you see any potential black swan events?
Yeah, that's always the thing that throws everything off here. We all look at the models. We all, have these demand supply forecasts, and it's always something that goes offline that no one was ever expecting here. Like I'll point to Western Canadian Select when that differential blew out last summer, and it was just because low Mississippian rivers weren't able to barge some of the heavy crude down, the river here, and so like no one has that kind of built into their models and that in terms of potential supply disruptions. And I think with this banking crisis that's going on, uh, you sometimes wonder, how does credit potentially dry up? And does that put a lot more supply constraint on some of these smaller operators? And it's the smaller operators who are generally the ones growing much more aggressively than your larger cap names here. And so there potentially is more supply at risk, I think, with the banking crisis than I think maybe it's, some guys, some investors fully appreciate. You look at, what are the other things that have caused black swan events over the last decade. And when you see inflation, especially some of the food inflation, this is where a lot of the supply and, these OPEC countries, that's what's caused, I want to say flare-ups in different countries here. So it's just, the potential when you have these volatile events, like the banking crisis, inflation, this is where other events transpire out of these type of scenarios that's just hard to be on anybody's forecast here. So when you look at, the spare capacity from OPEC, it's okay right now, but that can quickly get diminished, pretty quick here sometimes. That I think and when you potentially don't have the swing U.S. investors coming back online nearly as quick as I think everyone kind of thinks they could. That's where you suddenly get these price spikes once again.
Thank you. So things to watch out for. Now we'll move over to Leonid. I kind of wanted to talk about, right, we're kind of seeing this we are seeing deindustrialization of Europe. So what effect does this have on global metals demand, particularly base metals? And can Asia growing demand counterbalance this?
I think as usual, it's a question of the timeline, right? Because in the longer run, sure, right? I mean, the demand trends are what they are, mostly tied to, continued global GDP growth. And as we expect it to continue, maybe not led by our traditional sources of growth, right? But rather by new centers of growth, it is more than feasible to see that, maybe the sense of demand and supply will also shift. But that obviously takes a long time. And the question then becomes, what of the very near term, right? I mean, over the course of like one quarter, then I think that's where the challenges are. And I think this is why we're seeing the softness in the bases so far this year. Because the long-term story, if you look at copper and by implication aluminium, and you couldn't come up with a better story for the 5 or the 10-year horizon. But it's very hard to trade things, on a quarterly basis or on a monthly basis, even or even shorter than that, with a sort of 10-year thesis, right? And so the same applies for industrial demand and industrial purchasing decisions, right? You can be as optimistic as you like about eventual. You can be as optimistic as you like about the eventual consumption levels of these metals across Asia, but it's just not going to feed through this year, right? And so this year we're dealing with the European drag on all of this is very severe, and we can certainly feel it. And no, I don't think there's going to be an immediate way to substitute it.
Thank you. And then, all right, so we have, this is kind of a overall question, ESG, metals, et cetera. So we have the U.S. IRA Act. Also, Europe has passed their similar bill. But there's a lot of bureaucratic red tape and permitting problems on both continents, right? So how long do you think this is realistically going to take before we actually see these projects kind of come to fruition? And also kind of attached to that, do you see European companies moving to the US at all? It seems that we've already seen some European companies move to China due to high energy costs. You know, we see BASF move, et cetera. Do you see a potential for European countries to move to the US because the incentives are better?
Oh yeah, for sure. Right. I think we're seeing it now, and I think we've touched on this before. That this thought of using LNG as a source of your power generation, it's kind of for these long-term financing deals, it's just not digestible, right? It makes much more sense to bring the factory over than it does to ship LNG over sort of every couple of weeks or so, right? And outside of the cost, outside of the kind of the rerouting of gas supply, it's just conceptual in terms of security, in terms of making sure that nothing goes wrong, kind of thing, right? I mean, LNG doesn't pass that test as far as these long-term bank financing commitments are, right? And or at least for now, right? And I think in Germany in particular, this is it's being felt very acutely because just last year I was involved in a project that was trying to build an industrial facility in Bavaria and use Bayerische Landesbank as source of funds. And the LNG aspect of it was a key stumbling block. Just the nature of the intermittency of that supply, right? It creates a lot of problems for them for now. And again, these problems are bureaucratic in nature, right? And I can see them being overcome, especially in a pinch, right? Once you really see the a lot of these German businesses start to really offshore production. Yeah, I mean, I think they'll come around, but for now, right, it makes just so much sense if you're BASF to go and move that production to America, because in America you have a wonderful combination of availability of traditional sources and wind and solar, right? Whatever you like, you can get it done. The only real question is, right, what about the metals, right? Can you simplify legislation enough? Can you make the permitting process simple enough for there to be sufficient progress on this front? Because I think just last week, they've updated the numbers on how long it takes to get an average project off the ground, and I think globally it's still around 18 years or so, right? And that's just that's not going to help anyone. So I think the key point would be to see those changes, because right now I don't think it's good enough, especially in Europe. But over the longer term, there is enough time for things to change. But of course, as usual, we'll need to see some pain before, especially European politicians, consider changing things around. Now, the one thing I will say is we all talk about copper an awful lot, but we maybe forget about aluminium in the conversation, because maybe the story is a little bit less exciting. There not being the scarcity argument, but aluminium is actually a viable replacement metal for a lot of wiring in particular, right? Now, it's a bit more brittle and it doesn't do sort of hot and cold quite as well as copper, but in principle, there is an argument to be made. Obviously, it's less conductive, but about 60% of copper's conductivity. But there is a viable argument to be made that aluminium, especially if with a bit of chemistry, can be made into a reasonable substitute for copper. So maybe the argument there is that there is technological change that need to happen over and above the new sources of supply that will ease into this transition, right? So I'm personally very optimistic on aluminium for exactly those reasons, right? I mean, I just don't see the copper situation resolving itself purely with more copper supply being added to the market, and I think it'll be done through technological change and through metal substitution, and the primary beneficiary there will be aluminium, and that is something that I'm following very closely.
Excellent. And then, of course, we kind of touched on it, but we still got to go for the $1 million question. which is China, right? So the whole world's looking at China demand. So the data's come in softer than expected recently. Do you see this improving in recent months? I think BP in their latest earnings call said China is obviously the main story, where the post-COVID lockdown, we've seen strong demand on the retail side. The Chinese story from an industrial capacity perspective is still to play. But they happen to be, their quote unquote, it's why we're constructive on oil prices looking out throughout the rest of the year. So BP seems to think that China demand is going to come back, and they are constructive on that. Is that, do you see the same thing? Is that something you agree with, or you don't know?
Oh no, for sure. I mean, nobody knows for sure, but I think I'm very constructive on Chinese demand in general. But more specifically, this year has been very tough to predict because I sort of I feel like I need to keep reminding people that whilst we've seen the COVID restrictions start being lifted in end of November and really sort of heat up as we sort of came to the end of December, early January, the peak of oil imports actually fell on November, right? Why is that? Well, because they've updated the export quotas on products in August, September time frame, and Chinese refiners started buying oil in 3-4 months in advance of the eventual opening up. I don't think they knew there was going to be an opening up at the time, but for sure, Chinese purchasing started early, right? And this meant that there wasn't the same sort of bump into the opening up, because whilst demand picked up, they actually went into this with a fairly healthy level of commercial inventory. I mean, yeah, the Chinese SPR has been buying quite significant volumes, but in terms of commercial inventory, they've actually been quite well supplied. And of course, a lot of that had to do with supplying the US product market, right? I mean, with diesel spreads and sort of 3-to-1 spreads, where they were in 45, 50, sometimes $60, right? In September of last year. It's obvious that, your Sinopex, your PetroChinese, your Sinox would take advantage of that. And of course, then you put into the equation the fact that they do have access to Russian crude when most other refiners choose not to. It's not a surprise, right, that they're therefore the best performing oil names so far this year. And I've put the chart in a tweet sort of in advance of this, just to remind people that, look, right, I mean, Chinese oil companies are doing really, really well through a combination of factors: opening up of domestic demand, but also access to really cheap Russian imports. And this is another level of muddiness to the whole picture, because this means that the purchasing signals that they're putting out into the market are somewhat dampened by the access to the Russian market that is now being completely taken out of the visible side of the market, right? So the question of Chinese demand materializing physically and that filtering through into the observable universe, as it were, these are not one for one at this point in time, right? And then on top of that, you have to layer the fact that, as Jeremy pointed it out earlier, right? I mean, the COVID effects aren't even fully out of the US and Canadian systems. What can you possibly expect of a country that's only been out of it of controls for like 3-4 months? Now, it's not going to be a straight line, right? In fact, a colleague of mine has been in the Beijing airport, the old Capital International one, but still, just 2 days ago, and he sent me pictures, and nothing's open there. Not a single shop that he could find that would take his money, right? I mean, we are far from normal in China, and it'll take a while, because all the things that we were quite sort of keen on discussing in the States last year, right? Who's going to come back to work, who's not going to come back to work? Are the people who moved back into the country going to move back into the cities? All these things, to a lesser degree perhaps, but they're nevertheless a factor in China, right? I mean, work from home and impacts thereof, again, a factor in China. Because again, don't forget that China as a whole is actually really well connected with 5G across the country with a very high-speed internet. I mean, it's their internal version of the internet, but nevertheless internal connectivity is very, very high, and it's so much easier for them to enable themselves to work from these remoter places. Now, again, I fully expect them to actually be more rigid on this, and I fully expect them to be more rigid in terms of recalling people to work and making sure that everybody attends. But the fact that it's taking a while is maybe not in itself a massive surprise. Plus, there's, given just the level of concern that the country as a whole has had over COVID, and the fact that you still have reports of, this variant, that variant, flash of COVID here and there, it shouldn't be therefore surprising that the recovery is not smooth and is not linear. But I think the direction of travel is up and to the right. I think the direction of travel is China will set records in terms of oil demand, and it will continue to do so. And I think an interesting side effect of that is also, this murkiness of the Chinese data, both on demand and the supply side, is also impacting on the usefulness of the data that we get in Asia. Like, for example, traditionally, you look at Singapore crack spreads as, a good proxy for Asian refining and the refining margins. But what happens in the environment when you're not sure about costs of crude that goes into that calculation, right? So if you look at the Indian and Chinese refineries and how much Russian crude are they buying, what prices are they paying for it, what currency are they doing it in, right? And this means that all the data that we're currently getting, especially, anywhere outside of the US and Canada, really, all of a sudden you need to be a little bit wary and you need to be a little bit careful about the amount of extrapolation you're doing from it. And I think, it's only going to get worse in a way. I mean, worse or more important anyway, right? Over time, because it's not like China is going to open up any more of their data to us.
Absolutely. Well, we're coming up on the hour, you guys. So want to do what I always do. And so the last question really is kind of an open-ended question. Either you can talk about something that we haven't discussed yet that you wanted to, or what we should be paying attention to, for the rest of this year out into, 24, 2025. And we'll start with Jeremy.
Yeah, I would say there's increasing investor interest in the oil and gas sector. And given the valuation still as these companies continue to pay off debt, these are not the oil and gas companies from 5 years ago, a decade ago. These are completely new, revived businesses that are substantially more profitable than I think anybody realizes. And I think you'll continue to see that momentum come back into these stocks here.
Excellent. So we will definitely be keeping our eye on that. I mean, that's good news that if we see some longer term holders invest in the industry, that would be nice as well. And Leonid, your final comments?
I'm going to finish with Russia again. I think that if you buy into the theory that I've laid out sort of in the first question, that war is in fact a sort of negative event on oil prices, I think any resolution to the conflict will result in tighter markets and higher prices, contrary to maybe some of the theories out there at the moment. And I think this will become the most important event in terms of price setting mechanisms for oil, where you remove almost a forced seller out of the market and in fact replace him with a country who is more able to control its flows. So I am very sort of over and above the humanitarian considerations. I am looking forward to the end of the conflict there and its impact.
Excellent. Thank you to both of you. Did you have something you wanted to add, Jeremy?
No, just thanks you for having us here, Tracy. That's all. Yeah.
Yeah, thank you both. You guys
Thank you very
follow both
much.
of these people. They add a lot of information. Place your trades, find out what other events are coming on. And thank you everybody for attending. Really appreciate your time. Really appreciate the speakers' time. And we will be back next Wednesday. Thank you, everyone.
Thanks, Tracy. Bye.